G'day guys, Jackson Millan, the Wealth Mentor. Hope you're doing well. So I wanted to record a video to talk around this whole kind of Gamestop debacle of what's happening in the States at the moment with this kind of pump and dump strategy that's happening in the stock market. This is something that's been happening for a very long time. This is not something that's new, guys. But I wanted to give you some insights around how you can go about making sure that you can create the right portfolio that gives you the consistency that you need to be able to manufacture financial freedom. Because we've got to realize that situations like this are often tactical, are often very hard to predict, and extremely risky, and really I refer to them as gambling. So it's important that you've got the right insights to make sure that you're not just jumping on the bandwagon and you set yourself up for failure, and ultimately we want to make sure that you're always setting yourself up for success by investing in the right assets that have strong fundamentals. So there was a great book here called Valuable, written by a guy called Roger Montgomery. And Roger is a phenomenal investment mind based here in Australia. He runs a great fund. And really his approach is what's called value investing. It's very similar to Warren Buffett and some of the best investors in the world. And the idea of value investing is about understanding the true intrinsic value of a business and then being able to invest in that business because of the stock price being under what the intrinsic value of that company is. Meaning that we're investing in something that is kind of a hidden gem, and we are waiting for that business to then be discovered and the share price to accurately reflect the true value of that business over the long term. We find that value businesses are often ones that are consistent performers because it's based on the fundamentals of that business. Whereas growth companies can sometimes be hugely overvalued, and people are investing in them just because of the momentum that they have in the market, and essentially they're continuing to go up. Some really great examples of this would be Afterpay, Shopify, really big tech businesses at the moment would be seen as growth stocks. Now, one of the key fundamentals in this book is that we want to make sure that we buy businesses, not trade stocks. And this is one of the big issues at the moment with companies like Gamestop. It's because people aren't buying it because it's a good business. In actual fact, all of these hedge funds are shorting it because they believe it's not a good business. It's actually substantially overvalued. So they're trying to make money on the downside. And just because these Redditors saw an opportunity to try and trade up the price and essentially stop out these hedge funds, this is trading stocks. This is not buying businesses. As an investor, we should be buying investments and whatever it may be, whether it's shares, whether it's small businesses, whether it's property. We should be buying businesses based on good quality fundamentals. It needs to be a good business for you to be able to invest in it. So this is one of the key fundamental principles when it comes to investing. Now, what dictates value? Well, value comes down to a number of key factors. What is the profitability of that business? What is the cash flow of that business? What is the book value or the equity position of that business? And then what does the share price look like in comparison to all of those key variables? And what that allows us to do is to work out things like their price to earnings ratio, their multiples of book value, to understand, is there a fair valuation based on the stock price and market cap of that business to what the actual business is actually worth. The actual price of the shares doesn't really mean anything. Now, what true value comes down to is a couple of things. The first thing that comes down to is that price earnings ratio. For the earnings that the business makes, how many times multiple is that business valued at? Now, many businesses on the stock market are 12 to 16 times. We've seen some that go crazy as even 25 and 30 times earnings multiples. In some cases, there's businesses that are losing money and their share price is really a bit of a fugazi. It's a bit of a guess. So we want to have businesses that are profitable, and we want to have a reasonable multiple of recurring of that earnings. So we're making sure that we're not overpaying for that business. The next thing is the risk. What is the risk associated with the business? Is it hugely volatile in terms of the stock price? Because anytime there's some sort of announcement, the stock price goes up and down like a yo-yo. Is the business model at risk due to the current economic climate? All of these things need to be taken into account. And then the last thing is the growth opportunities. Is it in a growth sector? Is it in a sector that is likely to continue to grow and scale? Have they hit a point of minimum viable and they're now scaling up? Do they have a business that they've gone through R&D and they're now solidifying their product or service, and now they're going to be able to grow and scale that internationally? Whatever the data may tell you, we need to make sure that there are good growth prospects for the future. Now, if all of this sounds super complicated, you're not prepared to read books like this, and you want to get involved in the stock market, but you're just not sure where to start, invest in the exact same way that I do. And I personally invest in index-based investments, which essentially allows me to get an average of any particular market that I'm investing in by investing in all of the companies that are in that market. So some are going to do really well, some might not do so well, some are going to do average, but I'm going to get the average performance of that particular asset class over a period of time. So I don't need to worry about reading these complex, boring books. I don't have to worry about picking individual stocks. I don't need to worry about the timing risk associated with setting aside a time out of my business to be able to find out what is the best valuable business that I can be investing in next. This is just a really simple financial operating system that you can set up and you can ultimately forget about it. And all you need to focus on is the one important lever, which is how much you contribute to that portfolio. So hope this is giving you some value, guys. Let me know what your views are on this whole GameStop thing. Let us know what your thoughts are on value.